First of all, thanks a lot to the panel members for taking the time out. I know you guys are very, very busy, and it is a very, very difficult job. Because someone told me once that if you want to be a successful CEO of an insurance company, you need to be a magician. There are a lot of people that you have to please and a lot of things that you have to balance. So thanks a lot for coming down. I just wanted to start off initially on a topic that has been discussed a lot, and I think all of you have had recent experiences in this area as well. That is in terms of M&A. So maybe if you can start off, Walter, from your side in terms of and the same question from everyone, what are your thoughts, what has your experience been on the M&A side? You saw some of the case studies, so if you...
Yeah, so well, buying things, and 10 of those years getting rid of businesses. So I think M&A, for me, I think it's more difficult to get true value out of M&A. In my experience, I think it's been difficult. I think the integration processes, we've seen some examples of where it's positive, but on the whole, it takes longer and it's harder than the consultants will say on their lovely PowerPoint slides, right? So you pay a lot of money for PowerPoint and telling you how everything's going to go rosy and go well, but I think in my experience, it's the people, the culture change, the willingness of the entire new organisation to work together and extract those values. And I think, in my experience, that's proven quite hard to do and to extract real value. Now, if you have excess cash, and if you have time, and if you want to expand, and you have specific reasons why you want to do that, then M&A is a good thing. But M&A by itself is not a strategy. It's only an accelerator to your strategy. It's only an enabler to doing something that you couldn't do yourself.
Thanks, Johnson, from your side.
We have gone through 2 acquisitions. First one in the KSA and followed by the second one. Both were for a reason. I came actually to the insurance industry from a totally different way. I came as a CFO, and in Saudi Arabia at the time we had 34 companies, and we were one of the smaller ones. And I always believed it's good to consolidate. There's no point in competing on the same market. And we were looking for options. And again, in our case, we were owned by small shareholders. There was not a single shareholder owning more than 3%. When the rules were different, minimum 25% for second General Assembly, we had only 26% in the top 100 shareholders. It was extremely difficult. So for us, from many perspectives, it was important. And then came the first opportunity with MetLife, AIG, ANB. They were a late entrant into the market and finding it extremely difficult to do anything meaningful in Saudi market. And by then, we had grown to a reasonable scale. And it was actually meeting the minds. The board and management of MetLife felt that it's good to merge with a company that has a reasonably proven track record. And we decided. But in our case, again, since the other company was a smaller one, there was not much of a challenge with integration. When it came to people integration, it was relatively smoother because before even signing the agreement, both the parties agreed, obviously it's going to be run, who is going to be in the top positions, all that was agreed. So there were not much time left in the negotiation. It was basically the due diligence on the data. And so it went smooth, and there was obviously a lot of regulatory support. We started discussing merger in Saudi insurance, because every 2 years we have the Saudi Insurance Conference. I remember discussing it from 2014 onwards, and it was not happening. So the regulator was very, very supportive. They also ensured that it happened quite fast. The evaluation method was in principle. In Saudi, for any merger, there is no cash payout. It's always a fair swap. And we agreed that the evaluation is not adjusted. So all other methods would be considered, but eventually, so the methodology, the route was much more easier. And when it came to people integration, Again, a 400 employee company acquiring a 50 employee company was not much of a challenge. We definitely got some talent. The difficult part was probably the data integration. And we took a route whereby we decided to run off the portfolio rather than transferring the data. We chose the route of running off the portfolio, and it went well. And with that experience, again, we want to diversify. With this merger, we got a life insurance license. We always believed that in Saudi Arabia, at some point of time, a savings product will kick in, and we were not having a license. Instead of, giving a business plan and why not get a company with a product? So that was one area. And the second merger, it was SAP Takaful, owned 65% owned by SAP Bank, SPC company there. And again, they have not been very successful. There also, we got a portfolio. Again, this was the advantage. We got into this segment. We became probably the smallest. Overall, it's only 3%. The life insurance or protection and savings is only 3-4% of the total market. But we became the third largest player in the life segment. So in our case, it worked reasonably well. It was not easy, but again, the decisions were taken even before signing the merger agreement, at least on high-level decisions. So that made it possible. That's been my experience.
Yes, somebody said to me once that M&A didn't stand for mergers and acquisitions, it stood for mostly appalling. And I think the experience in our industry around the world has that M&A often hasn't lived up to the expectations that people who invested in it at the beginning thought they would get out of it. But that said, and for all its many difficulties and challenges, I think that at least in the UAE, I can't speak for other markets, but I think at least in the UAE, the current structure of the market probably isn't going to be sustainable. I mean, many of the presentations that we've seen this morning and in other conferences that we all go to, I think underline the many, many challenges that the industry faces. And it's not just about the pricing or underpricing of products. It's also about the regulatory challenges we face, the complexity of the digitization challenge, and the huge investment that probably needs to be made in that. The whole risk management, as we've heard, and many, many other areas of producing a modern insurance company, which is equivalent to how we see insurance institutions operate in more developed economies, will require bigger entities. I don't think there's really any doubt about that. The question is, how do you get from a market of 60 players or 28 public companies to one where it's probably more appropriately structured for an economy of this size growing as it is? It's certainly an emerging economy, but how do we actually get there? I mean, I was talking to somebody this morning who reminded me that there are basically about 3 or 4 companies in Japan, which is the third largest economy in the world. We've got 28 companies, probably 60 quoting entities in this country for an economy of our size. So I think if nothing else, I think that produces the challenge. So how do we get from where we are now to probably a more appropriate structure for the market? Well, I think it is a difficult thing. Quite frankly, if it wasn't difficult, we would have already done it, wouldn't we? In many ways. So I think that probably there will need to be some more regulatory push for it. My own view is that we're going to need to see an increase in the paid-up capital of insurance companies, and that in itself, if that happened, would trigger it, particularly if it was done properly over a period of time. So much as I hate to say it, I think there's no real alternative. The question is, how do we get cracking? And that I don't have any magic answer for.
First, before I get into M&A, Hatim, is it possible to get it from you in writing with your actuarial stamp on it that our role is deemed to be as magicians? I can take it to my board and I say that I have it from an official actuary and you didn't appoint a magician. So please don't blame me for the results. Let me talk about the experience that I'm going through, or we are going through right now, post the mega merger, in a sense, that took place in July 2022. Prior to that, I come from a background where we had done a cross-border acquisition when an Omani company acquired a majority share in an Abu Dhabi company. These were two small-sized companies, small to mid-sized. The Omani company was slightly bigger. The Abu Dhabi company was just about starting off. And the acquisition that took place was one of the first cross-border acquisitions. It had its challenges, but one thing definitely it brought out in the context of what we are going through right now, that there are M&As of different types, different reasons, different regions, different regulatory requirements, and each one of them come with their own, own issues and own challenges. For us, for all the reasons that have been mentioned in the presentation, M&A was something that we needed as a part of consolidation, was something that we needed as an organization in order to sustain ourselves. The opportunity that came our way and that we looked at and we went through with it, with all the the legal hurdles that were thrown across, and we had to kind of work around it. We did get a lot of support from the central bank, but there were certain areas which, because it was being done for the first time, had to be navigated, over a long passage of time. The interesting thing about an M&A, and I speak from my current experience, is that what you start off on your spreadsheet and PowerPoint is very different from the moment you actually get into it in reality. You literally throw away what you've gone through in the PowerPoint presentation and start fresh. They say that in global study, and depends on which study you're reading, more than 60 to 80% of these M&As don't deliver the results that drive them. In most cases, it has been seen that the shareholder value actually drops after a particular transaction. And we've seen some of that in our own case. And it's not so much about all the logistics of the transaction. A lot of it has to do with the soft part of the transaction. Doing an M&A for whatever reasons that drive it, executing the goals is a totally different subject altogether. And we've heard about the cultural aspect of a transaction. And in my opinion, as we are going through our journey, I think that is one area where we don't pay enough attention during the initial stages of due diligence, whether it is financial, whether it is risk, whether it is operational. The people and the cultural part are I think the most critical part that that I think most times determine the success or failure of transaction. So I would say that, as Jason mentions, M&A is something that, or consolidation is something that this market really has to go through in order for it to make its business sustainable, other than delivering to all the other requirements of the regulator and the business at large. But that sustainability can come through only from a consolidation exercise. Just for some data points, based on the Q3 result, and I was looking through some of the publications that have just come out, the top 3 companies have about 50% of the market. The next 6 companies have another 25% of the market. So basically between the first 9 companies, and the next 6 companies are behind the top 3. So 9 companies have about 75 to 80% of the market. and then remaining 50 companies, have different shares, and that really doesn't create a sustainable model for any business. So I think consolidation is the way forward, but the planning and the due diligence in this whole exercise and then execution of it, I think is something that we all need to be very careful about.
Thanks a lot for that. And I think, Jason, you were mentioning about the regulatory push. One thing that we've seen in Saudi is there is a very big helping hand from the regulator as well. And there are a lot of benefits as well that they provide as part of the, there are certain pools that they benefit from, you double that pool income, a lot of other benefits come in. When we were looking at the earlier presentations, we saw that still many companies were below the solvency threshold. So, Jason, if I can ask you, how do you think it impacts, in your case, how does it impact you? How does it impact the market, having insolvent companies still running in the market?
Well, how it impacts the market, I'll give you a practical example. That's poorly on all of us. That go down to the police station in Abu Dhabi today, there'll be a number of kiosks selling motor insurance, self-included. Some of the companies selling motor insurance, S&P 8-rated securities, and some of them are technically sold. And the insuring public have no idea the difference. So I think that, even in itself, if that was the only wrong thing, on that, I like the presentation this morning about unreconciled debt, the unreconciled recoverable between different insurance companies, which I hate to say, I think is a chicken that can pretty quickly, particularly in the days of IFRS 17. I think that some of that's going to get pretty ugly. So I think that we don't actually have the luxury. Can't hear me. I thought you were agreeing with everything I said. Well, I'm not going to say it all again, but there was somebody on the panel had to point that out. No, I simply think that if we're going to have companies which are technically insolvent, market maybe actually insolvent, I think that reflects badly on the credibility of the entire industry. The insuring public are not that sophisticated in this country, and in fact in many countries they wouldn't be that sophisticated to know the difference between. They think that all insurance companies are pretty much the same. They might know that one's large and one's small, but if it's licensed local jurisdiction, they think we're all the same. So we all get that reflects not badly on all of us, which I think is a big mistake. And as I say, I think the potential time bomb ticking in the market with irreconcilable balances between insurers of some of these motor recoveries and other recoveries, at least with other recoveries. I mean, you chose to do business. You have a motor recovery, you had no choice as an insurer who crashed into one of your cars, and it's hardly the fault of the poor old drivers on either side, actually, and the repair shop's not getting paid. So that, I think, is something that does need to be addressed very urgently.
Wondering if you want to add something on that?
Yeah, I just think this is a topic which is very close to my heart, and very close to us in Salama, as we're one of those companies. I think the industry per se needs strong insurance companies. We are a business of trust. We have to be there when our customers need us most, and we need that. So I welcome any regulatory efforts or stronger regulatory efforts that can be made on this. I fully subscribe to that. Secondly, more transparency so that customers actually fully understand what is behind the insurance companies. I think that's very, very important. And I think a focus and an understanding by everybody in other industries of what is it we have to do. We all want a better insurance industry in the UAE and beyond. That's what we want. And the way we're going to achieve that is by well-run insurance companies, sticking to the rules, doing what's required, paying the other insurance companies when the other insurance companies need to be paid. I think if we do the basics right, we will have a stronger insurance business and industry. We will increase trust. Not all insurance companies are the same, and I think it's our job as some of the leaders in this industry to make sure that we do everything we can to have well-run companies. And actually persuading our boards that solvency is a very important thing to do. And that, I have to say, in my own personal experience, can at times be difficult, given that we have board members that have multiple investments in multiple industries and multiple things, and trying to explain the importance of solvency is not always understood. So it's a job that we're currently doing and we're focusing on, and we will improve ourselves.
You want to add something?
Since there are no regulators over here, let me put in a plug for the regulators. Controversial as it may be, because we do take the first opportunity we get, we definitely take a shot at the regulators. But let's come closer to home. And early this morning, Jason and I, we were in another forum where we all talked about the insurance company taking the responsibility themselves. And I think that's one area where, as an industry, we haven't done very well. Yes, the regulators have licensed too many companies, but over the years, we haven't really behaved very professionally. And, unlike the banks, and there were a number of banks, but it seems that the banks seem to have done a much better job of running their business than we have as insurance companies. And we've tried to, when things have become difficult, we wanted somebody to help us through that issue, and sometimes they have, but we haven't really changed our own way of doing things. So yes, I understand that today we have a few companies that are well below the solvency threshold, that continue to do business, create additional exposure for other companies on their financial statements. But I think there is something that we also can do as an industry in order to ensure that we ourselves have enough financial base to make sure that something like this can be handled within ourselves. Now, this may sound all very theoretical, but if we look at our the way we do our pricing, the way we do our reserving, the way we create reserves for future contingencies, at this point of time, most companies tend to take their profit and, with few exceptions, take their profit and give it back to the shareholder as dividend. We don't prepare ourselves for contingencies. And we always say that, well, there'll be somebody else who will do it. And we try to still do it on the back of the reinsurers rather than do it on ourselves. From the regulatory side, I can say this much from my personal engagements over the course of last year or so. Central Bank, having taken over the insurance authority, they are still in the process of settling down, but they are a lot more supportive of any of these initiatives. I agree, they are not like Saudi, and I was part of an organization that had a base in Saudi, where a lot of things were done at regulators' instance. You either do it or you are out, kind of a situation. Now, obviously, we haven't gone down, UAE hasn't gone down that route, but I can definitely see Central Bank making these. At this point of time, they may be gentle, but I believe that soon those gentle will become a little more harder, which will push the companies into situations where they have to address the solvency either through additional capital or by way of mergers. Jason's point about raising the capital bar, that may also come, but regulators are moving in that direction, even though sometimes we may be frustrated at their pace.
You want to?
Not criticizing the UAE Insurance Association, but I must say, the Saudi, we have an insurance committee where we have ourselves, of course, with the support of the regulator, have taken a lot of initiatives. For example, this intercompany balances, when it comes to motor, salvage, and subrogation, it's automatic. You know, it's an auto settlement. Things happen, and if anybody is failing, then it's an industry issue. So those initiatives can definitely be taken. Of course, it is again managed by an organization or a company called Najam, which is again owned by all insurance companies. Intercompany balances, again, looking at the number, the transition impact on FR 17, if it was close to 300 million negative impact here, it was a positive 24 million impact in Saudi Arabia. Again, the conservative approach with which the reserving is done, again, the investment that you make. Here, if you look at the UAE balance sheet, maybe again it's part of the economic situation here. A lot of companies have significant investment in real estate and those kind of assets. In Saudi Arabia, we're not allowed to invest in real estate as of now. They may change. The view of the regulator is, yeah, when the insurance industry is matured, we will allow you to do that. The other one, we're not allowed to, except probably the large ones, even they are encouraged to not to pay cash dividend, pay bonus shares so that the company becomes bigger. A huge economy is run or managed by 11 banks. So why do we need 34 insurance companies? That was the thinking. So it has come down to 26. The regulators' interest, or what we hear was the long-term strategies, the number should be between 15 and 20. So a lot can be done by the players themselves. I think the big boys in the room should take the initiative properly, instead of making it.
Ralph Caban from UIB, United Insurance Brokers. So we are Lloyd's brokers, and my background is reinsurance. And on the reinsurance side, back in the UK, when I was still acting as a reinsurance broker, what we found in the reinsurance market was that the regulators didn't just allow any reinsurer to open up. You know, there was also, and the reinsurance players that wanted to come in would look at the market and see, okay, well, I can't do what everybody else is doing, the products that everybody else is doing. I have to find my own niche sector. The regulator here has basically brought in 65 or 60 insurers now, and they're all selling the same things. There's no specialization, there's no targeting of a specific need or demand for risk appetite. So it's more or less, even the takaful companies are basically not, you know, what I understand takaful is there has to be a profit share. That doesn't exist here. It's a different model. So from an insurance broker point of view, we don't see any differentiation between the products being offered by the insurers. That has to change. If you're not surviving because you're selling the same things that everybody else is, then you're only competing by price. And that is a downward, you're not going to do well, you know, if you're just competing on price. So there has to be a differentiator. From another point of view, which Jason made the point that it's up to the brokers, and I blame a lot of the brokers, and again, there's 176 brokers. When I moved here 18 years ago, there were 146. We thought that was far, far too much for the size. Now there are 176. So the brokers don't advise their clients. They should educate their client on the importance of solvency, which was, they should educate. So, because the regulator doesn't, and the problem we have is that we see a lot of insurers that are effectively insolvent, but are allowed to continue to work. And that is particularly dangerous on the medical side, because they then put the brakes on paying claims, and then you have our clients complaining. We say, well, you insisted on price rather than quality. We advised you of the poor quality and the solvency, but you just went with the price. So this is what you're going to get. So I think there has to be a multi-pronged approach. Unfortunately, brokers don't have a say in the market, and they're the only advocate for the consumer. It's not, unfortunately, right now, it's not the regulators. That's going to develop. Those are my points.
If I may have a little go at trying to answer. So innovation, yes, we have to innovate, and we have to change, and that's the job of the industry. I think in terms of education and insurance, it's all of our jobs, whether it's brokers, the regulators, the insurance companies, or the reinsurance companies. We have a large and important job to do, which is to educate. And like you rightly say, it can't all be about price. I think we have to differentiate ourselves on value, on service, on product innovation, and those things. There's more to it than price. And I think, unfortunately, especially where you get lines of business which are mandatory, then price, becomes very important because everybody's forced to buy it. So therefore, but there is a job to do to say the cheapest is not always best. I always use a term with the gang at Salama, which says, if you're buying a parachute, right, you wouldn't buy the cheapest. You wouldn't go down to Dragon Mart and buy a parachute, would you? Because you're only going to use it once. And when you need it, it has to work, right? Insurance has to be the same as that.
That's a good analogy. And I think this is one of the issues in this market, that everyone is doing everything. We don't have niche players like another market. Like there's no specialized travel insurance company. There's no a specialized company writing motor trucks. Everyone is writing every line, and they are competing on. And I think one of the thoughts was that once IFRS 17 comes in, because of the way the onerous contracts are supposed to be recognized, or how you're supposed to disclose all the loss-making contracts in your financial statement, we thought that will make a difference. So, and Johnson, you mentioned that you're coming in from a finance background. So I think your IFRS 17 implementation must have gone quite smoothly because you had support from the top. So just from your perspective, how has this impacted your company?
I must thank the regulator. Of course, it was difficult. All of us have gone through difficulty, but the regulator imposed us to start with the implementation process in 2020. It gone through 3 dry run before it was implemented, and Hatim, actuaries, auditors, you are also involved. They all contributed because it's a new topic. Even today morning, I've had some comments on the presentation made. I'm still learning, actually, some of the terminologies, because the books are still coming out, or your basic numbers are coming out in the IFRS form. Then you convert into IFRS 17. So that is still the basis. So as long as it is there, it's difficult to forget those terms, especially if you are used to it for a number of years. What we need is education. In our case, it took time. We had to educate. We have had, I think, 2 or 3 sessions for the board, then maybe multiple sessions for the audit committee. Even the regulator called all the audit committee chairmen for a session, ensuring that they are really involved in it. But again, Saudi Arabia, because of this regulatory push, we also spend a lot of money. In all this process, consultants made good money. I think the estimate is in Saudi, we spent something like, the industry put together 62 million paid to the consultant. That is a lot of money. And we went through this process, but at last we managed. For the first quarter 2023, the regulator, CMA, Capital Market Authority, gave a 1-month extension, and they said for the year end we are not going to get any extension. But we managed. It was not easy, but if you ask me, we are still learning. The KPIs are changing, the new definitions are coming. My biggest concern is, unless we do some kind of a standardization, so that is what we are trying in Saudi Arabia, a unified format is being worked up, where it may not be required under the FR 17 to disclose many things, But we believe for the public interest and to do some kind of benchmarking, the biggest challenge for smaller companies is to manage expenses. If today everything put under the carpet, you see only the insurance services. So we are trying to impress upon other colleagues as well as the regulator that there would be some disclosure by way of note on the GNA, the OPEX. Otherwise, people would not know. So that is where really you need to manage your expenses. Of course, the underwriting or the right price is fine, but again, managing expenses is also important. I must say it was not easy, but the industry as a whole gone through that difficult phase and came out reasonably.
And I think this is where some of the companies in UAE have actually benefited, because in Saudi, a lot of systems came out that, we'll solve everything. But the underlying data is still not. So that is where a lot of companies ventured into high-end systems. Here, because there was no push, so many companies have actually not purchased any system. They've actually gone down the sort of a managed service model. We'll wait for a year or two, let things stabilize, and then we'll go into. So effectively not being the first, it sort of helped the UAE industry, but again there are question marks on the quality of the accounts coming. Got it from your perspective. How have things been, because you're looking at multiple companies when the channel went.
Yeah, as Johnson mentioned, we are still learning a lot about the IFRS, the details of it. From just purely as a non-accounting person, but more from as an insurance operator, I see IFRS 17 as a way of correcting a lot of our existing loopholes or the gaps that existed. I've been in the insurance industry for more than 40 years, and I've seen how the existing system is amenable to manipulation, hiding things, etc., or a few things being deferred to the point where the ship sinks at the end when things come out. But there's always a hope that let me try to disguise it in the hope that next year will be a better one. I'm from a general insurance background, so I don't think long term. It's year to year, and next year I'll get away and I'll make up for it. IFRS 17 is a system where we can actually, and I think I was reading somewhere that IFRS 17 is like a mirror. You see yourself, your real self, when you look at it. So my hope is, and it's too early, we are just into the third quarter, it's too early for me to say that, how it will change or affect us, but I can only hope for that it will change us for the better. One of the things with IFRS 17 is, and that's an important part, is not so much about the technical accounting part or the changes in the technical accounting, but it brings me down to the change in the culture that it should bring in. When you start, today we still prepare our budget based on IFRS 4. The central bank still accepts E-form and IFRS 4. So, when it comes to a stage, only IFRS, exactly, only in IFRS 4, they won't even recognize IFRS 17. So we are still a few steps behind in trying to make sure that IFRS 17 gets implemented in a real manner across all our businesses. Because what IFRS 17 requires is for us to start thinking about it philosophically, culturally, operationally when we make our budget. Today, our budgets are still crafted on IFRS 4, which means there is still a tendency to think in terms of top line, to think in terms of the way we look at our expense ratio and combined operating ratio. So we are still not transitioning into the real IFRS 17. And I think give it another few more years, then we should start seeing the benefit.
Can I say something? Is it on? Look, I'm nobody's idea of a finance man, and I'm a retired LMX broker and a sort of motor underwriter. I suppose that's how I got here. And I won't go with the general consensus on the panel, I think. In my opinion, after 40 years in this industry, IFRS 17 is one of the biggest scams I've ever seen in my life. the idea of IFRS 17 and how it was sold to the insurance community globally was it would be easier to compare similar companies operating in the same markets across the world. How's that going? Even in this country, we've got massively different charts of accounts 3 quarters in. I can't work out what some of my competitors' loss ratios are without leafing through many, many pages of their disclosures. So I think it would be hard to be too cynical about why this was foisted upon us, and I don't personally see at this point any advantage at all. Hatim asked me the other day when he came to see me, are you actually thinking in IFRS 17? And of course the obvious answer to that is nobody's thinking in IFRS 17. We're all still thinking IFRS 4 and then translating it with a bit of translation software from Google into IFRS 17 later on. And that will be the case, I'm afraid. I mean, not that I'm suggesting for a moment that my objections to IFRS 17 will make the slightest bit of difference, or any of yours for that matter, to whether it's existing or not. We're going to have to learn to live with it. But I think it's one of those unfortunate examples. What was so wrong with IFRS 4, particularly here? I mean, maybe in the life world and in more sophisticated economies, maybe there was that. But when I came to this country 17 years ago, there was, under IFRS 4, there was an immense variation in the way things were reported under IFRS 4. And over those 17 years, I saw a much closer together and more aligned method of reporting. Of course, not completely aligned, but much more aligned as time went by. Now, the whole baby's been thrown out. We're back to square one again now, and as Gautam rightly says, it'll be 5 or 6 years at least before there's any consensus on discount rates and God knows what else. So, I'm sorry, I can't go along with the consensus.
I've spent a significant amount of my career in that life. So the element of the way you treat long-term contracts, I think IFRS 17 does that. I think we mustn't underestimate the sheer change and the effort the industry's had to make in terms of getting these numbers out. And I agree with the panel. Actually, I don't completely disagree with James' viewpoint. But in terms of how hard everybody's had to work just to push this out and get some numbers out, the real challenge that we're facing, and I think when I'm having conversations with other industry colleagues, is starting to performance manage your business on IFRS 17 is going to take some time. And we don't really know how to optimize the numbers or the levers to pull fully to make our IFRS 17 more relevant to us and to do that. And that's going to take some time. And I think we're probably looking at a number of cycles, so a few years, I think, of going with this mishmash of IFRS 4, sticking it through a meat grinder, and then some IFRS 17 numbers come out, rather than actually working on IFRS 17. So I think we've got some way to go yet.
And I think that there's an interesting connection to that as well, because right now if you're doing your budgets on IFRS 4 basis, it means you're evaluating your management, you're evaluating your team on IFRS 4 basis. But your shareholders are going to evaluate you on IFRS 17 because they are only interested in dividends.
I would, from my experience again, I've seen, because the shareholders really don't understand the complexity of IFRS 17, notwithstanding the number of presentations that have been given to them, to the board, they still want to see IFRS 4. They'll say, okay, this is IFRS 17, which is what we're declaring, but can you show me the accompanying IFRS 4 and give me a waterfall to see what the differences are? But they are still looking at gross written contribution. They are still measuring growth on that basis. They don't understand what insurance service expenses are. How do you break it down? What's your expense ratio component? And you say that your insurance revenue is net of ECL. That's a whole different ballgame altogether. So I think it's something, first it'll take time to settle down. Now, on Jason's point, I would agree to the extent that had there been a more disciplined disclosure system in IFRS 4, then we wouldn't have needed IFRS 7. IFRS 17 was more trying to take away the, the so-called misuses of IFRS 4. But was it that extensive? Would it have been changed? That's another debate altogether.
The real question is, can we change it? And well, I think we're stuck with it, right? And we're going to have to learn to live with it. I think that's the reality. I think Jason was right on that. It's been thrust on us. We've got to deal with it.
But one thing I'll say, it has definitely given actuaries more control than the statutory auditors.
This is actually what I was telling someone, that this is the first time accountants have actually created a standard and given actuaries more power.
Yeah, I just wanted to add one or two points. I can understand Jason's frustration. I hear the same from, including the rating agent, the analyst in the rating agencies. I hear that from the investment analyst every quarter after the results. We have had, I think, at least 2 phone calls with the analysts, the investors, and explaining it. They're learning. Our own employees are still learning it, because we had a meeting recently and we said the underwriters that you are going to manage the P&L and you would be responsible for your numbers. The biggest challenge is up to the conventional loss ratio part, they're okay, but this allocation of expenses, attributable and non-attributable. So it takes time, but eventually, again, standardization is required. For example, the discount rate, at what rate you are, all that, I think that is where the industry, together with the regulator, has to come up with some kind of a standard. You cannot put a number which is going to be the rate, but in Saudi Arabia, most of these, there was a working group with the regulator. They came up with a lot of standardization. If you are way off the mark, then you would be questioned. Those things have to evolve, and this is basically the profit, it's the timing issue. All that would be really understood as we go forward in a year or 2 or maybe 3. But there are a lot of advantages, especially the details. Earlier, you would be able to cover a bad account along with a few good accounts. All that is going away. So underwriters would become a lot more disciplined and accountable. So also the management, I believe. But yeah, it was probably rushed, and many of the terminologies, again, it's all there, whether you call it LIC, LRC, or outstanding claims and IBNR, it's all there. All that real understanding, that is what is missing. I think it will come. It needs some time and a dedicated effort to teach everybody, first within the organization and then to the other stakeholders.
And that's an important point as well. Like in Saudi, they've sort of said in terms of attributable expenses, it has to be around 80% or more. If it is less, you'll have to justify. When we are doing the analysis in UAE, we realized that the attributable are going from 30% to 90%. There was a big range. And that also has an impact on the onerosity and other. I actually wanted to ask one more question, but I think because of, we are also running close to the time, so from the panel, I think there are certain questions.
Thank you very much. This is Arif Khan. I'm representing Europe Assistance as a part of Generali Group. I would like to ask, considering the current market trends and the global emerging risks, right? How, as an insurance company, do you see the synergies between the reinsurance industries in the region, and what do you expect in your strategy, apart from the other gentleman mentioned? Like it's always more focused on the pricing, when there's brokerage involved, there's fronting. So what other factors do you think are important when it comes, to work collaboratively for a successful business in the region with an reinsurance company? Thank you.
Well, thank you for the question. I think that I think it's fair to say that most of the changes that happen in the reinsurance arena in this part of the world are not caused by things that really come from this part of the world. They tend to be global factors, and often the real changes come for things that are actually completely outside the reinsurance industry's control. You know, if you think about the big turning points in the life of the reinsurance industry over the last 25, 30 years, I mean, they would be things like 9/11, the global financial crisis, 2008-9, COVID, rising interest rates and rising inflation, and none of those are particularly insurance or reinsurance phenomenon. Now, of course, some trends have been exacerbated by a growing number of cat claims of higher value, which I guess a lot of people would argue is a result of climate change. Whatever the cause of it, I think we can acknowledge that the result is there, and the results have been worse. But I don't think that most of those changes really have a particular Middle East flavour. The Middle East is a fairly small part of the global village when it comes to reinsurance. But that doesn't mean that we're not, it's obviously very important to us. So I think what we've seen in the region is reinsurers that came from the region and concentrated on the region probably could never get the spread and the range and the volume of business to make a good business out of that. And I think that we've seen, you know, the wreckage of that to some extent over the last 10 or 15 years. But those people who have set up in the DIFC have contributed to the ecosystem of the reinsurance business in the region. I think, you know, on balance, a very positive contribution that the DIFC has made to the market, brought expertise here and capacity. I think that's a great positive. We don't see a lot of treaty capacity within the region, or certainly not the DIFC, and we're still a region which, to some degree, you might say, if you're an outside observer, rather perversely, relies very heavily on proportional treaty reinsurance. And it's odd in some ways because a lot of companies, I'm speaking particularly of the UAE, but a lot of companies actually, counter to what we were saying earlier actually, but a lot of companies are extremely well capitalized in the UAE. And although we've seen a trend of the bigger companies, I mean myself included, of reducing our expenditure on reinsurance over the years, it's still a very important part of the mix. And people find that rather intriguing, I think, sometimes from outside. The simple reason is, I think, it's a purely economic reason. It's actually quite a good deal. You're swapping uncertainty, the certainty of commission. And whilst that is always challenged by, you know, the ups and downs of the market and even, you know, big changes in the market, like interest rates going up and COVID and all that sort of thing, that still seems to be pretty much the case, doesn't it? And whilst there might be differences at the margin, I think we'll probably go on seeing for the next few years anyway, global reinsurers offering proportional treaty capacity at encouraging commissions. I think if that changed, I think you would see a very, very rapid cultural change in the way business was underwritten in the region. Because we've all grown up, let's be honest, we've all grown up writing, talking now about property casualty business, not talking about motor and medical, but the property casualty side, we've all grown up writing against the treaty. I mean, most people's authority in insurance companies is seen as, you know, divisions or multiples of the treaty capacity. It's as simple as that. So that would be a very big cultural change. Not many people in the region have moved to an excessive loss program. Where they have, it's usually because they've been forced to, and they got back into proportional treaty very quickly as soon as the results have got a bit better. So I think those are the factors really that are challenged, but I think many of them still remain the same.
Any other questions from the audience side? I think since we are running close, like kind of exceeding the time as well, any closing thoughts from the panel? if
Closing thought, that's always a tough one. You know, being in an industry which does not have any, it's not close-ended, it's open. So putting a closing thought becomes tough. But I think the closing thought is something that we've discussed on this panel, and we keep talking about it outside, is that the insurance industry needs to change. There are, you know, looking at technology, looking at the pace at which things develop, insurance industry cannot fall behind. And we, at this point of time, are at the cusp where some critical decisions need to be taken in order to get to that next level. Whether we basically look at it as our own survival, or whether we look at it as something that becomes sustainable in the long run. And that is, my closing thought is that, you know, we've talked about a lot of things, and we've deferred a lot of decision points for future, but I think we are getting very close to the point where we can't defer these decisions anymore. And as part of the industry leadership, we ourselves need to make sure that we take the right decision for the sake of creating a more sustainable industry.
Yeah, I agree very much with what Gautam said. I think I'd just put it in one sentence, is that there's no alternative but to become more excellent. And if we don't, I think there'll be plenty of disruptors and organizations that we haven't even thought of yet that will come and eat our lunch. So we have to be careful of that.
I'm optimist with all the challenges. As the economic activities in the region is booming, insurance industry has a lot of opportunity. As Jason said, we need to change with the time. 3 years ago, the aggregator business in Saudi Arabia was 20%. It became 40%. Last year, 2023. Currently, it's about 70%. So things are changing. The distribution model is changing. But there is business. Business is growing, and economic activity is growing, so business will grow with the low penetration. I think better days are ahead, but we need to catch up with the time. It's a capital-intensive business. So definitely investment is needed. Number of companies can come down and have a level playing field, the better. But I'm hopeful that insurance industry will do in the coming.
So insurance plays a pivotal role in society. We have a hugely important role in creating stability and protecting the things that are important to people, to countries, to individuals. And I think that we mustn't ever forget. So we work in a brilliant industry. I think we have some way to go, and I'm with Jason on this. I think when you look at this wonderful country that is the UAE, just how it leads the world in architecture or airlines, which is a hugely competitive industry. I think if you look at insurance, you wouldn't necessarily say that the UAE insurance industry, which is the one that I can speak about, is necessarily on the same sort of league as a sort of Etihad or an Emirates Airlines in their world, right? So we have a long way to go to improve. We welcome more regulatory development, and we're here to support, and I think we all have to work together for a better and stronger industry, and with that there will be consolidation, there will be innovation. Otherwise, like Jason rightly said, somebody's going to eat our pie.